What if I told you that the biggest threat to gold and silver prices right now isn't coming from the Federal Reserve, and it isn't coming from inflation numbers either? What if the next big move in precious metals is actually being decided thousands of miles away, in Japan? It sounds hard to believe, but in the last few days, one of the most important events in the global financial system took place, and almost nobody in the mainstream media is talking about it properly. The Japanese yen just had one of its biggest weekly moves in decades. As of today, the dollar-yen rate sits around 157, after the pair had spiked as high as 163 to 164 just last week, a level not seen in roughly 40 years. Behind that swing was a suspected intervention that has raised serious questions among economists, currency traders, and macro investors. Some are calling it a stabilization effort, others are calling it outright manipulation. Whatever you want to call it, this was not a normal currency move. It involved central banks, government institutions, and decisions that could eventually shake bond markets, stock markets, and yes, the future direction of gold and silver. Welcome back to Macro Bullion. I'm Alex James, your independent gold, silver, and macroeconomic analyst. On this channel, we don't chase fear, we don't chase hype, and we don't trade on emotion. We look at central bank policy, debt markets, currencies, and precious metals so you understand what's actually driving prices behind the headlines. And before we go further, one quick thing. All the figures I'm sharing with you today, gold prices, silver prices, yen rates, treasury yields, are pulled from verified, up-to-date market data, current as of this recording. Markets move fast, so always check live prices before making any decision. Right now, gold is trading close to $4,050 an ounce, and silver is holding near $58 an ounce. Both metals have had a strong run in 2026, and what happens next in Japan could be one of the biggest hidden forces behind where they go from here. Today, we're connecting several major events that most investors are looking at separately, but which are actually deeply linked. We'll cover the sudden intervention in the Japanese yen, why the US Treasury reportedly got involved, why America's bond market may be entering a genuinely difficult period, and why all of this could end up pushing capital toward gold and silver. By the end of this video, you'll understand why serious macro analysts are watching Tokyo more closely than they're watching Wall Street right now. Let's start with what actually happened. According to verified market reporting, the Japanese yen had weakened dramatically against the US dollar over the past several weeks, at one point trading above 163 to the dollar, a level that took the currency back toward territory not seen in decades. Then, in the space of just a few sessions, the yen reversed hard, strengthening sharply and pulling the dollar-yen rate back down toward the 157 to 158 range. Reports from financial outlets, including the Financial Times, indicated that the Bank of Japan stepped in to support its currency, and that the Federal Reserve Bank of New York, acting on behalf of the US Treasury, sold euros to help buy Japanese yen as part of that intervention. That detail matters because it means this wasn't just Japan acting alone. The United States appears to have been directly involved in defending the yen. Now here's the natural question. If you hold gold or silver, why should you care what happens to the Japanese yen? At first glance, Japan's currency looks like a completely separate story from precious metals. But global markets don't work in isolation. Currencies move bond markets. Bond markets move interest rates. Interest rates shape borrowing costs. Borrowing costs shape economic growth. And all of that eventually shapes investor demand for safe haven assets like gold and silver. A shock in one corner of the financial system doesn't stay contained. It spreads. That's exactly why experienced macro investors never look at one market in isolation. They study how currencies, bonds, stocks, and commodities move together. The working theory here is that this intervention wasn't only about protecting the yen for its own sake. It may also have been about preventing broader stress from spilling into the US Treasury market. Whether that interpretation turns out to be fully correct, we don't know yet, but it gives us the framework for everything else in this video. And here's where it gets more interesting. US Treasury Secretary Scott Bessent has publicly flagged concern about excessive volatility in the yen and described the currency as undervalued relative to Japan's economic fundamentals. Those comments have fueled real debate about why the United States would help stabilize another country's currency. Was this simply about calming excess volatility, or is there a bigger financial problem building underneath the surface? Because if it's the second one, then what we just saw in the currency markets might only be the opening move. And that takes us straight into why Japan's role as one of the largest foreign holders of US government debt makes this entire situation matter far more than most investors currently realize. So why exactly would the United States care this much about the Japanese yen? On the surface, it doesn't add up. Japan runs its own central bank, its own government, its own economy. So why would the US Treasury reportedly step in to help stabilize someone else's currency? The real answer takes us straight into the global debt system, where trillions of dollars move every single year, and where one country's decision can ripple across the entire world. Japan is the largest foreign holder of U.S. government debt, owning more than $1.1 trillion in U.S. Treasury securities. Japan ranks among the largest holders of U.S. debt overall, alongside groups like U.S. banks, Social Security, and the Federal Reserve itself. That makes Japan one of America's most important creditors, full stop. Here's why that matters. When the U.S. government spends more than it collects in taxes, it covers that gap by issuing Treasury bonds. Investors around the world, including foreign governments like Japan, buy those bonds because they're seen as one of the safest assets on the planet. But there's a catch. If one of your biggest buyers suddenly becomes a seller, the whole market feels it. This is the real risk. If the yen keeps weakening, the Bank of Japan may be forced to keep defending its currency. One way to do that is to sell some of its U.S. Treasury holdings, convert those dollars into yen, and use that yen to support the currency in the open market. Simple on paper, potentially enormous in its consequences. Financial markets run on supply and demand. If a massive holder like Japan starts selling hundreds of billions of dollars of U.S. bonds, the available supply jumps sharply. When supply grows faster than demand, prices usually fall, and bond prices and bond yields move in opposite directions. So falling prices mean rising yields, meaning higher interest rates across the board. That's not just a Wall Street problem. Higher yields push mortgage rates up, make corporate borrowing more expensive, raise the cost of auto loans, slow business investment, and increase the interest expense governments themselves have to pay. This lands at a genuinely difficult moment for U.S. finances. The Treasury is already facing a massive refinancing task, with roughly $10 trillion of debt needing to be financed during 2026 and another $11 trillion during 2027. Right now, the 10-year Treasury yield is trading close to 4.7%, its highest level in well over a year, while the 30-year yield has pushed up near levels last seen back in 2007. Try refinancing trillions of dollars of debt at the exact moment one of your biggest foreign buyers might be forced to sell. That is the scenario serious macro investors are now watching closely. Let's slow down and connect the dots properly, because this is where the analysis really matters. Stocks tend to grab the headlines, gold gets a lot of social media attention, Bitcoin dominates the trending charts. But underneath all of that noise, it's the bond market that quietly sets the cost of money for the entire global economy. When bonds get unstable, every other major asset class eventually feels it, whether that's equities, real estate, currencies, or commodities. Now bring gold and silver back into the picture. Neither metal pays interest, neither one hands out a dividend, but neither one carries the default risk that comes attached to government debt either. That's a big part of why investors turn to precious metals whenever confidence in government bonds starts to wobble. If bond market stress keeps building, the historical pattern is that capital starts rotating toward traditional safe havens, gold first, and silver often following with a lag, sometimes catching up fast once it gets moving. We're already seeing early signs of that kind of rotation. Gold sitting near $4,050 an ounce and silver near $58 an ounce both reflect a market that is already pricing in real uncertainty around currencies, debt, and central bank credibility. But here's the important nuance, and I want to be very direct about this. None of this means gold has to spike tomorrow. Markets almost never move that cleanly. What this actually tells us is that if trust in government debt keeps eroding over time, demand for alternative stores of value like gold and silver tends to strengthen with it. That's a structural shift, not a single-day headline trade. There's also a second lever sitting on Japan's side of this equation, separate from bond selling, and it's arguably even more dangerous for global markets. Japan could choose to raise interest rates instead of or alongside currency intervention. For years, Japan has kept rates near zero, and that gap between Japan's low rates and much higher rates elsewhere fueled something called the yen carry trade, where investors borrow cheap yen and use it to buy higher-yielding assets abroad, including large chunks of the U.S. stock market. If Japan raises rates meaningfully, that carry trade starts to unwind. Investors have to sell those foreign assets to repay yen loans, and that kind of unwind has triggered sharp, fast sell-offs in global markets before. So we now have two separate pressure points building from the same source: potential treasury selling pressuring U.S. bond yields higher, and a possible carry trade unwind pressuring global equities lower. Both scenarios point toward the same beneficiary historically, and that's precious metals. So where does this leave us heading forward? Based on everything we've walked through today, the most likely path is not a single dramatic crash or a single explosive rally. It's a slower, grinding shift. Watch three things closely over the coming weeks. First, whether the yen stabilizes near current levels around 157, or whether it starts weakening again toward that 163 to 164 zone, which could force Japan's hand once more. Second, whether the 10-year Treasury yield keeps climbing past 4.7%, since that would signal growing stress in the bond market. Third, whether the Bank of Japan actually moves on interest rates at its next policy decision, because that's the trigger that could accelerate a carry trade unwind. If those pressures keep building together, the historical playbook says gold and silver tend to benefit as investors look for assets that don't carry counterparty or default risk. Gold holding above $4,000 and silver holding above $55 would both be consistent with that kind of rotation continuing. But if Japan manages to stabilize the yen without further drastic action and Treasury yields cool off from here, this specific pressure point eases, even though the longer-term debt story doesn't go away. That's the honest, balanced read. This is not a guaranteed outcome. It's a framework for understanding what to watch and why it matters. I want to be completely transparent with you. Everything discussed in this video is based on publicly available, verified financial data and reporting current as of the time of recording. Currency rates, bond yields, and metal prices move constantly, sometimes within minutes, so always check live prices before making any decision. This video is for education and analysis only. It is not financial advice, and you should always do your own research, DYOR, before making any investment decision involving gold, silver, currencies, or bonds. If this breakdown helped connect the dots for you between Japan, the bond market, and precious metals, hit subscribe and turn on notifications, because we're going to keep tracking this story as it develops, especially around Japan's next policy decision and the next round of US Treasury refinancing. Drop a comment and let me know, do you think gold and silver are heading higher from here, or do you think this yen story cools off? I read every comment, and I'll see you in the next one. This is Alex James for Macro Bullion, signing off.